Good morning, everyone. Welcome to the new week and the macro snapshot. We're recording this on Monday, June the 30th, 2025, about 7:20 in the morning. Okay, so basically this week, we're going to get quite a lot of sort of updates on the situation in terms of what do I mean by that? Hopefully, there's probably going to be a bit more information about tariffs. At this point, we're also probably going to get information about the one big beautiful bill, this whole big sort of package which Trump wants passed. There's a lot of data, especially coming out of the US. There's an ECB meeting, the central bank meeting, where all the big sort of central bankers globally are in Sintra in Portugal. And there's also maybe you're going to get a bit more information about what Trump's been saying about bond issuance. So maybe let's just start across over in Europe. We know at this point that the ECB have cut quite a lot. They seem to be on pause. They're waiting for more information. And we know that sort of inflation seems to be sort of at a level which they're comfortable with. So this week in Sintra, actually basically starting today, you have the traditional sort of summer meeting, not only of ECB officials, but a lot of other people. So I believe Powell will be giving a speech there. We also have, I believe, Bailey and Ueda from the Bank of Japan, and of course Lagarde and other Europeans. So that's going to be quite interesting just in terms of policy. I'm not necessarily expecting anything dramatic, but definitely we have to be listening out to that. And as I say, I do expect, I think Powell is participating either on a panel or giving a speech. So that could be interesting, any kind of update there. Also, secondly, to be listening there is if there's some kind of coordinated message, because we know that when these global central bankers get together, will there be some kind of sort of coordinated message of, about the tariffs or cutting interest rates or something else? We'll have to keep an eye on that. So anything, let's keep an eye on that. Secondly, we had over the last, basically going back to Friday, Trump is getting increasingly annoyed with Powell not cutting. And he basically is starting to put out this idea that until the new Fed chair comes in next May in 2026, he will instruct the US Treasury not to issue any long-term bonds. So no long-term bond coupon issuance, no more sort of auctions, which would be an extraordinary step and very, very strange. And I do believe that, sort of the technocrats, the officials at the Treasury would push back on that, because part of what they like to do is to maintain trust in the system and to have a deep and liquid market. And if the US Treasury were to suddenly sort of stop bond auctions for the long end of the curve, let's say the 10s and the 30s, that would create, I think, distrust and a lack of trust or less trust in the US sort of bond issuing mechanism, which technically would be a disaster. However, what Trump is saying is that he's saying, well, let's just sort of finance the deficit through bill issuance. So just like T-bills and, very short duration. And his logic there is that, what's the logic behind that? The logic behind that is that if the US government or the US Treasury were not to issue more sort of long-term bonds for, let's say, 6 or 9 months, that would be a lack of supply, which in theory would be sort of a huge amount of, let's like extra liquidity into the system and less sort of pressure on long-term yields. Now, what would that do? That would probably cause like an inflation surge, and assets such as sort of stocks and gold would probably rally very, very substantially, and probably initially the long end of the curve as well. And of course, the US dollar would probably suffer quite substantially. So, but I don't think we're getting there. I think that's just sort of a rhetorical kind of move, but people are starting to model that out and basically saying, hey, this is almost like QE if the US Treasury stops sort of issuing bonds and 10-year notes for 6 or 9 months. I don't think we'll get there, but if we do, that would certainly be almost like a sort of a QE kind of situation. And we also know that the US Treasury is trying to sort of free up a bit of liquidity in terms of banks and the in terms of the liquidity requirements. So definitely what they are worried about and what they're concerned about, Trump is definitely trying to get the 10 and the 30-year yields down a bit more. And it looks as though he's increasingly looking at sort of more unorthodox measures. So let's keep an eye out on all of that. Now, in terms of other stuff, we also have the one big beautiful bill over the weekend. It got through the first stage of the Senate. So what needs to happen is that the Senate actually has to vote in it. Then it has to go back down to the lower house, the House of Representatives, to confirm any changes. So of course, there's a lot of horse trading going on, this and that, and this and that. But essentially, the key thing to keep in mind here is that Trump keeps on talking about tax cuts, but what essentially would be doing would be to be extending the so-called TCJA, which is the which has already been in place. So what Trump wants to do is to extend that. So the point is that would this be more stimulative for the economy? Not really, because it's something which has already been in place for a year or two or three. And so therefore it's simply sort of the status quo is being extended. So what would actually be more problematic would be if it weren't to be extended, and suddenly that would be a taking away of a little bit of stimulus. I've been reading this morning some research. Some people are saying that, over the next 7 or 10 years, the bill as it currently stands may add an extra, 3 trillion, 3.3 trillion to the budget deficit. So you could say, well, is this going to be stimulative? But just looking through the details, which I won't bore you with, it's such a long-term thing, and the numbers are not, it's not like some huge package of infrastructure or something. So I'm not sure just how stimulative this will be, and I'm not sure that the market will take this as stimulative. And if anything, I think the market will simply take this as a lack of fiscal discipline, as say, a little extra money over the next 5 or 10 years apparently being added to the deficit, which, in theory should be a little bit of a negative for the long end bonds, which could put a bit more upward pressure on the bonds. But as we just sort of spoke about, Trump is very keen to avoid that. So there could be other more unorthodox measures to try and sort of, in essence, to have some kind of yield cap. The other issue is that we're getting up towards July the 9th. Now, July the 9th, of course, is the putative date set by Trump as sort of a deadline for a lot of the tariffs. He changes his position all the time. Over the weekend, he had an interview with Fox, and he was saying that if countries didn't play ball, maybe the US would just unilaterally send them a letter, essentially saying what tariffs they'd have to pay. But at this point, just reading again some research over the weekend, it looks as though if you sort of average things out, where we are at the moment, it's about 17.5% of tariffs. Now, as we'll be saying a lot, that's substantially more than we've had for the last 50 or 60 years, certainly since the end of the Second World War. So the point is that, it has that effect, which could be a drag on the economy. Has it come into the economy yet? Has it shown its effect? No, it doesn't seem so. But until and unless we get substantial reductions in that current level of tariffs, the reality is that at the moment there are sort of, tariffs being put on most of US's trading partners, which one would think at some point would start to sort of slow down consumption and be felt in the US economy. And the thing is that a lot of the inventory which people are still buying is inventory in goods, which is from it's a little bit older, from a few months ago, and it's not actually reflecting yet the new inventory, which will be subject to tariffs. And this is what the Fed is worrying about sort of inflation. Of course, the idea here is that remember that in terms of the overall GDP, only about 40% of it is on goods. So you have about 60% of the GDP, which is services. And it looks as though service inflation, if anything, is slightly moderating, so going down a little bit. So it's going to be a complex issue. No one exactly knows, but it could be that service inflation, as consumption comes down, actually starts to attenuate and to diminish a little bit. And there could be a little bit of sort of goods-based inflation. But as I say, keep in mind that goods apparently is about 40% of the US economy. So it's not the whole economy, it's about 40% of the economy. And actually the larger chunk of the economy is in the services sector. So it's a complex factors. And of course, if we just look what happened to Canada over the last 72 hours, we had Canada on sort of Friday afternoon basically imposing a 3% digital services tax, which would have affected a lot of those huge American sort of tech companies. Trump threw a tantrum and immediately broke off negotiations with Canada. And now we've seen that Canada, I think it was yesterday or maybe early this morning, rescinded that 3% digital services taxes and essentially said, sorry, Trump, we won't tax your big companies. And now just this morning, we have Howard Lutnick, the sort of the trades from the US, essentially saying, great, thanks, Canada, let's keep on talking. So you can see it's a very volatile sort of set of negotiations. And if Canada and the US, if those negotiations are anything to go by, there's going to be a lot of toing and froing. And at this point, we still don't have anything with Europe. We don't have anything with Japan. We don't have anything with China. But as I say, July the 9th is the putative deadline. The deadline suggested. So let's see what happens there. But my personal feeling is that A lot of this has the market has had time to adjust in a certain sense. So at this point, we have to be looking for shocks. So shocks would be if a lot of the sort of so-called deals happened and the tariffs were reduced to, something sort of much less than, let's say, 10 or 12 or 17%, down to 1 or 2%. And I think that would be a net positive for the market. On the other hand, I think the market would get a nasty shock if, for example, in Europe, the tariff deal, there's nothing done, and actually it looks as though the tariffs were going to be sort of permanently at 25% or something. I don't think that's going to happen, but they're the kind of extremities, the extreme outcomes which we have to look at. I'll just grab some tea here. The other thing, which of course is very, very important, is that this week, probably the most important thing, we're going to get a huge amount of data. So basically, we're going to be getting the JOLTS number, jobs opening and labor turnover. We're going to be getting ISM services and ISM manufacturing. We're going to be getting the ADP employment number. We're also going to be getting, of course, the big one, which is going to be on Thursday, because Friday is July the 4th holiday for US markets. So on Thursday, we'll also be getting the non-farm payrolls. Now, the whisper number is about 100,000. The consensus at this point is a little bit more, for about 120,000. And we'll talk about that later in the week. But essentially, by the end of this week, we should have, as I said, a much better sense of what's going on with tariffs, the one big beautiful bill. We're going to have any kind of commentary from central bankers coming out of Portugal, etc. Maybe some update on whether Trump is serious about wanting to not, for 6 or 12 months, issue sort of long-term bonds. And of course, we're going to get all of this data. So at that point, the market, and let's just look at the market, we'll see. It's either going to continue this confirmation of this sort of optimism. So let's have a look here at the ES. And you see here that the stocks, on all of this news, basically saying that, the tax cuts are going to be extended. There could be less bond issuance. Trump is trying to get the long-term bond yield down. There's going to be trade deals announced this week. It looks as though the Fed is, sort of feeling the heat and actually will sort of cut. And if we actually look at what's going on with the Fed, we can see that if you just look at the CME Fed Watch tool here, you can see that for the July meeting, most market in terms of market pricing, about 80% for no cuts. But as soon as we get out to September, this is September, you can see here that suddenly the majority of the positioning in terms of the futures is for one cut, and even there's 20% here for two cuts. And then once we get out to, let's say, sort of October and then December, you can see that really consensus here is that we will have cut quite a few times. And if you just look at that in terms of the probabilities, you can see here, this is where we are at the moment, with the Fed funds rate between 425, 450 target. And you can see that as we go out, this is September, you can see that the probabilities start building for sort of cuts. And so by the end of the year, at the moment, so if you go to December, which is this one here, you can see that the highest probability in terms of positioning, 50% probability, is actually for 3 cuts. So I was just looking at the Bloomberg, the terminal having some connection issues, but it's about 2.5 cuts is sort of the consensus at the moment. But there are a lot of people positioned for 3 cuts. And as you can see here, again, if you go to the CME, look at the SOFR tool here, you can see that in terms of the SOFR pricing at the moment, approximately 3 cuts here priced in by the end of the year, less so for next year. So what's going to be kind of interesting with all of this data is just going to be whether this sort of dovish repricing is going to be reflected in the data. And I think there is a possibility. Let's say, for example, we get all of the data is actually strong and showing a labor market and a general economy which is doing well. I think there could be some some pretty sort of strong repricing back, a little bit more hawkish. Certainly, I think like half a cut, maybe 12 basis points will be taken out of the SOFRs. And also in terms of spread trades, could be interesting that there's been a lot of a lot of the cuts have been pushed into 2026, and essentially this idea that the Fed will probably be cutting a lot more in 2026, maybe because of the economy deteriorating. But secondly, the idea is that the new Fed chair will be a mega dove, and that's who Trump will be appointing. On the other hand, if we do get sort of a pretty strong economic data coming this week, I think we could have a little bit of a shift away from that whole dynamic, and some of that sort of dovish repricing could be sort of taken out a little bit. So let's see what's happening. happening there. So very important week coming up. So just again, just looking at a few charts here, we see that the equities continue to push higher. Unless they get bad news, and there could be a lot of bad news, there could be a lot of good news, or a mix this week. It looks as though equities at this point, you're starting to look at things like sort of Fibonacci extensions and to say, well, okay, where could this go? So depending where you sort of plant your flag, definitely this could extend a little bit higher. And if we actually want to go from this impulse down here, one could argue that we could even get up to about the mid 6,000. So definitely a little bit higher. Nasdaq doing very well. You can see that's well above sort of all-time high. So now getting into unknown territory again, that could sort of extend out. Europe not doing as well, but still quite solid. If you look at global indices here, you see something like the Korean Kospi having a bit of a pause, a very, very overextended. It's almost parabolic, but that's still sort of looking quite strong. Emerging markets are enjoying this weaker US dollar. Emerging markets are doing pretty well. And also at this point, it's interesting that the bonds, if you look at the front end of the yield curve here in the US, you see that the 2 years had fairly dovish repricing here. This is the ZT future, so the 2 year, that's, as you can see, that's pushed up a lot over the last sort of 7 or 8 trading days. Again, on anticipation that A, the economy might be starting to weaken, and B, that sort of Fed cuts are coming, in one shape or another. But what's interesting, if you look out at the long end of the curve, the ZB, it hasn't rallied quite as much as the front end of the curve, but just overnight and the last couple of days is holding up, quite well here. Again, we've got a bit of a technical resistance here, sort of a Fibonacci retracement level 61.8, but it looks as though it wants to sort of poke a little bit higher, and especially if Trump really starts to get this narrative rolling that the U.S. Treasury will be issuing over the next 6 months less coupons. And by the way, we're going to get an update on that. It's going to be very interesting for the next quarterly refunding announcement, which I believe happens in a month. We'll get that just to see exactly what the Treasury is planning in terms of future auctions. But you can see that even though the curve has been sort of bull steepening, it's actually just taking a little bit of a pause here. And if we actually just look here at the curve, let's have a look at the 230s. You can see that it did steepen a little bit, but it's just sort of taking a little bit of a pause. And if we look at the 2s10s, you can see here it's actually just flattening a little bit. So the market just sort of holding off and just trying to understand exactly what the US Treasury's plans are. In terms of other markets, the dollar continues to be weak. Even if you look at USD CAD, you see that it's something like on Friday when it was announced that Trump had suspended negotiations, you can see here that the US dollar did pop, but it's already giving that back. And if you just look at a general index, let's say the dollar index, you can see it's just trading very, very heavily. It's under all the moving averages. It's under, all of the moving averages. It's now below, it couldn't even rustle up any kind of real resistance. It failed at the, basically between the 20 and the 50-day moving averages. This downtrend is still holding. So this is an instrument which just seems to want to go down. Any good news, it's popping, just a little bit modestly for a day or two, and just doesn't seem to have any energy for any sort of upward momentum. So it looks as though it's a sort of a sell the rally situation here for the US dollar. And therefore we have to look at the euro. Now, the euro is not getting any sort of necessarily independently positive news, but as you guys can see here, as we all know, it's been more or less on an uptrend, since the beginning of the year, had a bit of a retracement, running out of a little bit of energy here, maybe just pausing, maybe just waiting for all the updates, which we're going to get in the middle and towards the end of this week. But at this point, this seems like the least dirty shirt, as they say, in terms of the currencies. Just finally, having a quick look at oil. Again, oil not doing much. As I was saying last week, as you see here, 1, 2, 3, 4, 5 days after that big sort of issue in the Middle East with Iran and Israel, that seems to have calmed down a little bit. We're in a bit of a pause. Again, the market for oil is just trying to figure out whether actually there's got to be continuing global growth, which would obviously be good for oil, or whether we're just going to be in a sort of a stasis situation where, growth is not great, but it's not horrible. There is extra sort of supply capacity. Countries like sort of Saudi Arabia have plenty of extra supply capacity if needed. So the market knows that, so it doesn't really want to rally. On the other hand, there is reasonable demand, so it's just sort of in a sideways pattern. So not a lot of money flow going into oil at the moment. I think we need a bit more information about the overall sort of global trajectory for the global economy. And then finally, just looking at the precious metals, gold Let's have a look. Gold actually is coming off a little bit. But again, I was just thinking about this over the weekend. All of the structural issues are still positive for gold. Relatively sticky inflation in theory. We have fiat currencies being debased. We have a weak US dollar. We have sort of central bank buying. So there's still plenty of good structural reasons to buy gold. So at this point, it's just a question whether this is just some sort of kind of sideways consolidation. I know a lot of institutions are calling for gold, at $4,000 by the end of the year. I think I read something over the weekend calling for gold to be at $6,000, within 5 years. So there's still plenty of sort of good reasons to buy gold. So personally, I'm looking at this 100-day moving average level. I think this would be a pretty interesting level to get in at about 3150, 3200, something around there. Just let it bleed down a little bit here, maybe over the summer. We shall see. In terms of silver, have a quick look at that. Again, silver is sort of the poor cousin of gold. Again, holding up towards highs. Nothing bad here, no negative price action really. This is still a positive chart. You look at the moving averages, all pretty good. Similar kind of situation. Remember that silver is a little bit more sensitive to industrial demand and therefore is a little bit more cyclical. So again, any sort of positivity on, let's say, the US sort of Congress passing Trump's bill, maybe the trade deals coming in, the tariffs not being too onerous, and let's say a debasement of the US dollar. There's no reason why silver can't sort of retest its highs. Just finally having a quick look at copper here. Copper had a big sort of push out. I can't see anything particularly fundamental in terms of, Chinese sort of infrastructure stimulus or, sort of massive global growth. Of course, there's always going to be a structural bid for copper because of, the grid and electrification going around the world. But a lot of this, as far as my research is telling me, there's some technical issues in terms of inventory at the London Metal Exchange, a fear of tariffs on imports going into the US. So there's a little bit of hoarding and a little bit of inventory squeezes and whatnot here. So wouldn't surprise me here if copper just does come back to, let's say, do a bit of a fib retracement. In fact, I might just update that. Let's say, something round about 4.85, something just sort of coming back here a little bit. We'll see what happens there. Okay, guys, I'll leave it there for today. As I say, not a huge amount of data today. Keep your eyes out for headlines from Portugal, from Sintra. And then, of course, tomorrow, we're going to start getting a lot more sort of data, Sintra headlines, and probably a bunch of stuff about tariffs and the one big beautiful bill. And we'll have more updates on all of that. Thanks very much and have a wonderful day. Thank you.